Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, Persistent Systems has slipped in trade as analysts say the top client, United Health, is in trouble. Sandip Agarwal, who is a fund manager at Sowilo Investment Managers, joins in with his take on this. Sandeep, hi, welcome to the show. Well, if we could just start by talking about this issue with United Health. Have you looked at the news, and what kind of impact do you think it could have on a stock such as Persistent?
Hi, good afternoon, and thanks for having me on the show. So, we run a PMS and our clients hold some of the stocks, so it will be very hard for me to comment on any particular stock. But let me put it this way that, there is a lot of disruption going around in the healthcare side in the US market, and also there is some disruption going on in the auto and manufacturing pieces in Europe. And that's the reason the R&D companies are seeing very volatile numbers. Some of them are seeing very good numbers. Some of them are seeing little poor numbers. And I think this volatility will be there for some more time. And wherever, there is a combination of disappointment due to volatility along with higher valuation, we have seen the stocks getting corrected.
So in a situation like this, what is it that you're doing? Because, what we understand is it could be a little more than 10% of revenues for Persistent and a little more than 3% for Wipro as well. I just wanted to know if those estimates are correct in one's understanding. And if that was to happen, could there be some more uncertainty here? Is that revenue at risk?
So I will tell you generally what happens. I have seen this during 2 decades of my working in this sector, that, a particular client's revenue could be X percentage, but out of that, generally, not everything gets impacted. A certain portion of that gets impacted unless the client has gone for bankruptcy or the client has completely shifted to a new client or those sort of things happen, which is not clearly the case right now. So, so in this kind of situation, generally, as a portion of the overall contribution which comes to the revenue does generally get impacted. And remember that, it is not permanently impacted. Once this thing settle down, then, they come back also very strongly. We have seen this multiple times, not exactly same kind of issues, but different kind of issues which have paused spends for some time, but they have come back very strong after some time. Because see, this is the lowest possible price at which you can execute. So generally, the execution of outsourcers doesn't get cancelled or totally. It only gets delayed by some time. The worst hits are one which are which are the front end discretionary ones where the rates are very high and they are nearshore vendors. Those get hit very hard.
Okay. What do you, while we can't talk stocks, what do you think is the impact on a larger number of IT stocks because of this particular piece of news? Do you think it's limited, or do you think that is going to have a widespread impact?
I think, there will be impact, but this impact, prima facie, the issue which has cropped up, this impact is a time impact and not a actual loss of revenue. It will be postponement of revenue. So maybe 3 to 6 months, you will see some postponement. But I don't see as a permanent impact because, in the US healthcare, we are very deeply entrenched and we are the lowest cost executioner there. So we have not seen any impact for longer term in US in last 10 years in the healthcare sector. Anytime this kind of issues have happened, it is company specific and generally it remains for 1 or 2 quarters and then, it starts normalizing.
So as a PMS owner, are you looking at this as an opportunity to increase your stake in these companies, or are you looking at this as an uncertain time, so maybe reduce some weight and perhaps get back when the things are looking a little better?
So Mangalam, we were massively overweight IT last year in August when, there was gloom and doom. All the stocks were trading like at a very, very low valuation. And since last 4-5 months, we have clearly said our view also on national channels that, we are cutting down our IT weight. We are not comfortable at these valuations because, see, this is a sector where large caps can grow between 5 to 8% on a regular basis and the good quality mid caps maybe 10 to 14%. And for that, giving a PEG ratio of more than 3 times, 4 times is very difficult for us. We are very, very, value conscious fund. So we have trimmed down our IT position in a very, very significant way in last 4 months. And we have very minimal position now. We will enter when we find that, the risk rewards are favorable and the valuations are little reasonable. Right now, The rally which has happened is broad rally. I think that, this year will be a weak year for IT. I don't see big numbers coming in this year.
Okay. All right, Sandip, we're going to leave it on that note. Thanks very much for your quick take and for joining in and telling us about your thoughts with regards to the IT space. We'll take a short break now. Aditya Agarwal of Invest for Edu will join in with his trading call. Stay tuned.